Hi, welcome to Pauline Young's channel. The telecommunication industry in Malaysia has undergone some major structural changes and corporate mergers and acquisitions in the recent years due to the arrival of 5G. Recently, there was a merger talk between Axiata and Digi. In fact, this merger talk was not new. In March 2019, when the news of Axiata and Digi M&A talk emerged, we saw both Digi and Axiata prices gapped up. However, in the same year September, when they announced the plan was failed, we saw both share prices gap down. This round, is this merger talk a genuine one? How would this merging affect the telco industry? In this video, let us examine the fundamental of the telco and the media sector stocks and to rank them according to their market capitalization. Before we continue, don't forget to subscribe to our channel and to click the like and the bell buttons so you will immediately get notified when a new video comes out. According to the Malaysia Prime Minister Muhyiddin Yassin during the My Digital launch, Malaysia aims to offer 5G services by the end of this year. The 5G implementation will be handled by a special purpose vehicle (SPV), which is owned by the government. An investment of 15 billion will go into the 5G implementation for a period of 10 years. The SPV is fully owned by the Ministry of Finance. Instead of assigning spectrum to individual telcos or to a consortium of private companies, the 5G spectrum will be allocated to the SPV. This entity will be tasked to roll out the 5G infrastructure and network nationwide. According to the chairman of MCMC, Dr. Falullah Suhaimi Abdul Malik, having a single entity will ensure an efficient rollout and use of spectrum. Since the government owns the network assets, he added that the approach will help reduce the investment burden on the telcos and they can offer 5G services through a transparent wholesale agreement. Telcos will gain equal access to 5G while they maintain its Jendela plan commitments of expanding 4G population coverage to 96.9% by 2022. This development was a U-turn from the previous government, where they preferred to award a number of spectrum blocks via open tender based on the concept of a single entity comprising a consortium formed by multiple licensees instead of individual licensees. However, this plan was not materialized due to the pandemic. Nevertheless, whether the spectrum is awarded by the government or open tender, the telco industry is undergoing some mergers and acquisition to strengthen their market positions. The table here is an overview of the players in the telecommunication and media sector. Under the Telco Bursa Malaysia stocks are Axiata, Maxis, Digi, Telecom Malaysia, Time.com, OCK Group, Green Packet, and Redtone. Under the media industry, we have the Astro and the Media Primer. In the next section, we will rank them according to their market capitalization. Rank number 1 is Axiata Group Berhad with a market capitalization of 37.6 billion ringgit. Celcom Axiata Berhad, a unit of the Axiata Group Berhad, is merging with Digi.com Berhad to create the biggest mobile service provider in Malaysia. This time round, it is the merger of their operations in Malaysia. Unlike the previous mega merger plan in which Axiata and Digi.com's Norwegian parent Telenor ASA tried to merge their operations in the Asian region and became the ASEAN largest telco provider. However, the plan failed through after 6 months. Having learned from the experience, this round, the merging involved only the Malaysian operations. As the high-growth era is over in the mobile service industry that requires large capital expenditure or capex, a merger to achieve economies of scale is seen to be a logical move going forward. As at April 10, Axiata was trading at 4 ringgit and 11 cents, PE ratio 102, ROE 2%, profit margin 1.5%, dividend yield 1.7%, debt to equity is 1, and the cash reserve was valued at 7.2 billion ringgit. Rank number 2 is Maxis Berhad with a market capitalization of 37.5 billion ringgit. Maxis has been served with notices of additional tax assessment with penalties of 230 million ringgit for 2018 and 2019, mainly due to the disallowance of interest expense deductions. This is the same rationale for the additional tax assessments of the 140 million ringgit back in the 17th of November 2020. As in the previous assessment, Maxis will contest the basis and validity of these assessments, including an interim court stay of the enforcement of the notices until the case decision. It is noted that the management did not make any provisions for the additional tax in the fourth quarter of 2020. Likewise, pending the outcome of the court, it is not expected that the Maxis to make any immediate provision for the full sum of 370 million ringgit, which translates to 25% of the financial year 2021 net profit. Operationally, Maxis overall subscriber growth regained traction in the fourth quarter financial year 2020, rising by 145,000 quarter-on-quarter to 11.3 million from both postpaid and prepaid. However, fourth quarter of financial year 2020 average revenue per user or ARPU for prepaid and postpaid slid 1 ringgit per month quarter-on-quarter to 32 ringgit per month and 77 ringgit per month respectively from new subscribers at a lower entry price. Sequentially, home fiber users climbed 25,000 to 402,000 and business fiber increased by 2,000 to 42,000 in the fourth quarter financial year 20. While commendable, this lagged TM's fourth quarter 2020 unified subscribers, which have increased by 128,000 to 1.8 million, 4 times of Maxis fixed broadband users. Maxis capex rose 24% to 504 million ringgit for fourth quarter financial year 20, which translated to a slightly 2% year-on-year increase to 1.2 billion ringgit for the financial year 20. This was largely spent on its core network capacity expansion, translating to 16% of service revenue and largely in line with the group's earlier financial year 20 forecasted capex guidance. As at April 10, Maxis was trading at 4 ringgit and 80 cents, PE 27, ROE 19.6%, profit margin 15.5%, dividend yield 3.5%, debt equity 1.4, cash reserves valued at 735 million ringgit. Rank number 3 is Digi.com Berhad with a market capitalization of 34.7 billion ringgit. The proposed merger with Axiata will create the largest telco in Malaysia with a combined mobile subscriber base of 19.1 million users. Celcom and Digi announced that they will be merging through their parent companies Axiata Group Berhad and Telenor Asia, and both parties will have equal ownership estimated at 33.1% each. Axiata together with Malaysian institutional investors will own over 51% of the merger. As part of the merger transaction, Axiata will receive newly issued shares by Digi representing 33.1% post-transaction shareholding and a cash equalization amount of around 2 billion ringgit. 1.7 billion ringgit of which will come from Digi as new debt, with a balance of 300 million ringgit from Telenor. The merger will be named Celcom Digi Berhad and it will continue to be listed on Bursa Malaysia. As at April 10, Digi was trading at 4 ringgit and 46 cents, PE ratio 28, ROE 201%, dividend yield 3.5%, debt equity ratio was very high at 9 times and its cash reserve was at 302.8 million ringgit. Rank number 4 is Telecom Malaysia Berhad with a market capitalization of 22.98 billion ringgit. TM is expected to benefit from MyDigital in 2 main ways. Firstly, TM Wholesale is expected to benefit from leasing its extensive fiber network for the 5G rollout and the US tech companies' usage for the data centers DC. Secondly, TM1 stands to benefit from greater adoption of cloud services and data center usage. As the only home-based cloud service provider, TM has an edge over Google, Microsoft, and Amazon in housing cloud data in Malaysia, a crucial requirement to some users of cloud services and data centers. As at April 10, Telecom Malaysia was trading at 6 ringgit and 9 cents, PE ratio 23, ROE 14%, profit margin 9%, dividend yield 2.3%, debt to equity 1.07 times, cash reserves valued at 5 billion ringgit. Rank number 5 is Time.com Berhad with a market capitalization of 8.5 billion ringgit. Time.com has a competitive advantage in its pure fiber optic network. A pure fiber optic network is, as its name describes, a telecommunications network or backbone made purely of fiber optic cables. It is capable of speeds orders of magnitude faster than a copper network or copper fiber hybrid network that offered by its competitors. Time.com registered fourth quarter 20 core net profit of 112 million ringgit, which represent a 20% gain quarter-on-quarter and a 7% gain year-on-year. The outperformance was attributable to the all-time high core EBITDA margin of 51%. As at April 10, Time.com was trading at 14 ringgit, PE ratio 25.8, ROE 10.8%, profit margin 26.8%, dividend yield of 1.5%, debt to equity was almost zero at 0.02, and the cash reserve was healthy at 750 million ringgit. Rank number 6 is Astro with a market capitalization of 5.1 billion ringgit. Astro's competition came from globally such as the illegal TV box, Netflix, and Amazon Prime. Revenue skidded by 9.5% year-on-year on the back of the declines in the TV and radio businesses, but partially cushioned by the rise in the home shopping segment. The TV segment was lower largely due to the lower subscription revenue, while the decrease in radio was due to the lower lower digital advertising or ADAX from lower road traffic due to the lockdown restrictions. The increase in home shopping was the back of a shift in the consumer spending habits amid COVID-19. The core after-tax profit increased 20.3% year-on-year due to lower marketing and distribution costs, finance costs, and tax expenses. The core after-tax profit declined 12% year-to-date in tandem with the contraction in the revenue. Despite the declining revenue, Astro has the highest dividend yield of 5.6% among the top 10 stocks in this category. As at April 10, Astro was trading at 98 cents, PE ratio 9, ROE 50%, profit margin 12.4%, debt to equity 2.8 times, and the cash reserves valued at 1.26 billion ringgit. Rank number 7 is the Media Prime Berhad with a market capitalization of 737 million ringgit. Media Prime Berhad is Malaysia's leading fully integrated media company with TV3 and TV7 and the 8 Chinese News, which are the local popular TV channels. Media Prime Berhad posted a net profit of 18.1 million ringgit for the fourth quarter ended December 31st, 2020, reversing the 106.3 million net loss a year ago. It is the second consecutive quarterly profit after registering a net profit of 11.8 million ringgit in the third quarter. This reflected encouraging results of its business transformation efforts initiated in the early 2020. Losses were significantly reduced by 90% to 18.1 million ringgit in the financial year 2020 from a loss of 185.5 million ringgit in 2019. As at April 7, Media was trading at 67 cents, PE, ROE and profit margin were negative, and the debt to equity was 0.22 and the cash reserve value at 303 million ringgit. The above analysis is for information purpose and we do not initiate a buy call or a sell call. At the point of recording, we do not hold any of the stocks mentioned in this video. Thank you.